So it's now my privilege to introduce more formally Randy Quarles. Randall Quarles grew up and graduated from high school in Roy, Utah, and then went east to Columbia College, as did George Eccles, where he received his Bachelor of Arts degrees in both philosophy and economics from associate with Davis Polk and Wardle in New York and I think London. Is that right, Randy? Yeah. In 1990, he joined the Treasury Department in Washington as Special Assistant to the Secretary and was later appointed Deputy Assistant Secretary. Mr. Quarles returned to his law firm as partner upon completion of his term in the Treasury. His career would then follow a pattern of moving in and out of government and the private sector to increasing positions of responsibility. He again joined the Treasury Department under the presidency of George W. Bush, serving as the U.S. Executive Director to the International Monetary Fund, as Assistant Secretary for International Affairs, and ultimately as Undersecretary for Domestic Finance. This time, when he left government service after 5 years, he was awarded the Alexander Hamilton Medal, Treasury's highest honor, and then joined the Carlyle Group, one of the world's leading private equity firms. In 2014, he co-founded Cynosure, an independent alternatives and asset management firm headquartered here in Salt Lake City. In October of 2017, Mr. Quarles again entered public service as Vice Chairman of the Federal Reserve System with specific responsibility to ensure stability of the financial sector. He remained at the Fed until December of 2021, as he remarked this morning, December 24th, 2021, the Christmas gift that he gave to Elizabeth Warren. For the last 3 years in his role, he also served as the chairman of the Financial Stability Board, a global body established after the great financial crisis to coordinate international efforts to enhance financial stability. Mr. Quarles played a key role in successfully preventing the collapse of the U.S. and global economy and widespread disruption to the financial system through the COVID-19 pandemic. He has now, again, returned to the Cynosure Group as executive chairman. Having held senior financial policy positions in 4 different presidential administrations over the last 35 years, including 6 confirmations by the U.S. Senate, he has a unique and rich perspective on monetary and economic policy. I think it is safe to say that if there were a list of 5 people in America today whom we would most want to hear from on the topic of monetary policy and financial market stability, 3 of those names would be Fed Chairman Jerome Powell, Treasury Secretary Janet Yellen, and Randall Quarles. We could then have a debate about who the final 2 names would be. It's a distinct honor, Randy, to welcome you to this podium.
Yeah, let's see, I can get a little garrulous, so I'll put this here. Thank you. Thank you, Dean Anderson, for that extremely kind introduction, and I'll make sure to quote it to my wife when she reminds me that I have once again forgotten that they come to pick up the garbage on Thursday mornings instead of Friday mornings. The folks in the Dean's office responsible for publicizing this event asked me to give them the title of my remarks some months ago, and I hope it doesn't seem like slacking to admit that this was long before they were written. So I gave them the title, Does Jay Powell Dream of Electric Sheep? Which seemed like a good idea at the time, in part because with a little ingenuity I could wrestle that title into fitting almost anything I wanted to talk about, but more specifically because of its reference to Philip K. Dick's novel, in which technological advance, after a world-devastating event, has created a dystopian world. And my concern is that some of the pressures on the Fed over the years to come, resulting in part from financial technology the Fed developed in its response to the COVID event, might create a similarly dysfunctional future. But before we get there, I think we have to acknowledge that a few things have happened in the weeks since I gave the university this title, and it's meet and right that I should take some time at the outset to address them. So on March 10th, 2023, just about 1 month ago, Silicon Valley Bank, a regional bank in the Bay Area that had become the preferred bank of the venture capital and startup community in Northern California and really across the country, was seized by the California Department of Financial Protection and placed into receivership with the Federal Deposit Insurance Corporation. The bank had suffered a devastating bank run, with $42 billion in deposits being drawn on the day before its failure, and the expectation that as much as $100 billion might leave the following day. This was the second largest bank failure in the history of the United States after the failure of Washington Mutual in 2008. Its troubles were accompanied by contagion affecting many small and regional banks on the continent, around the country. Signature Bank, a similarly new economy-focused bank on the other side of the continent, was seized by its regulator on the same day. In the following week, deposits at small banks across the country fell by $119 billion. That's the largest amount that was ever recorded in a single week. Half of those deposits moved to the largest banks in our system, JP Morgan, Citi, B of A, Wells. The other half moved out of the banking system entirely to money market funds and other instruments, including direct holdings of Treasury securities. While the exodus of funding from smaller banks has largely abated, it has not yet begun to reverse itself. There's some speculation it may never reverse itself fully. Now, in Washington, where every misfortune is viewed as an opportunity for battle in the Manichaean struggle of good against evil, the search for villains has begun. Both the Senate and the House of Representatives held hearings last week grilling the federal banking agencies, with the Democrats blaming the agencies for technical changes to banking regulations in 2019 that changed the safety guardrails around Silicon Valley Bank, and the Republicans blaming the agency's supposedly feckless and haphazard supervision, distracted by soft social goals such as equity and climate change, as the real culprit. But in banking, as in life, the search for villains is almost always the enemy of the search for understanding, and there are lessons to be learned from the Silicon Valley Bank episode, and some fruitful questions for further study that are at the moment being drowned out by the drumbeat of the Washington Inquisition. First, what exactly happened at SVB? SVB was a 40-year-old bank started in 1983, having been conceived during a poker game by two friends and tennis buddies, one a Wells Fargo executive and the other a Stanford professor. The idea was to provide banking services to tech startups in the rising Silicon Valley. Those tech startups didn't really fit into the banking models of the 70s and 80s. Most of them didn't have revenue, but they had prospects. And banking them meant underwriting those prospects rather than their income or assets. Silicon Valley Bank was good at that. They had a very low failure rate on their loans. The bank expanded into providing additional services useful to new companies, and importantly, to the venture capital firms that sponsored those companies. The bank became a key hub in the extensive network of venture capital, law, and accounting firms that grew up around this startup culture. And eventually, it became common for the term sheets of the dominant venture capital firms in the Valley to require new startups to create a bank account at Silicon Valley Bank. By 2022, the bank's market capitalization had grown to $40 billion. Two friends, with a clear insight, developed a great business model and executed on it with vision and discipline. Exactly how you're taught it ought to work in business school. Unfortunately, while SVB was a great business model, it actually wasn't such a great banking model. It turns out that tech startups don't need a lot of profitable banking services. They certainly don't need a lot of loans, usually the bread and butter of a bank of SVB's size. They're generally well-funded with venture capital money. Their principal banking need is to place that money somewhere friendly, hence the VC's requirement to use Silicon Valley Bank. SVB's deposits grew dramatically. And in their business model, they had limited places to deploy the money. They chose to invest it in the safest and most highly liquid assets imaginable, Treasury securities. They earned a small spread between the cost of their deposits and the earnings on their treasuries. This became problematic as interest rates fell in the aftermath of the great financial crisis. Earnings on Treasury securities fell emphatically, and while the cost of the deposits fell correspondingly, the earnings capacity of that model shrank. The spread on a certain level of assets was just smaller as an absolute number. Now, there would have been a few ways you could have addressed that. For example, they could have found loan opportunities outside the VC and tech startup community. but that would have muddied their message and their branding as the bank of startups. So they chose to address their earnings compression problem by, as the finance quants say, buying duration. They kept their asset portfolio as liquid and credit risk-free as ever, but they bought treasuries with longer and longer maturities. Now, those securities have a higher interest rate risk. If interest rates rise, the current value of those securities will fall, but that only matters if you have to sell them. These are treasuries, so there is no reasonable chance that they will not pay you back when they mature. So if you have the capacity to hold them to maturity, and in SVB's simple model, why wouldn't you? The interest rate risk should not matter, or so they believed. All of this came home to roost in 2021, when the first inflationary episode in over 30 years began to develop. For banks with a simple maturity transformation business like SVB, like the savings and loans in the 70s and 80s, inflation is murderous. Interest rates rise simply from market forces, as the market requires compensation for expected inflation on top of the underlying real rate of interest. And that's even before the inevitable response of the Federal Reserve in raising interest rates even higher than unfettered market forces would have in order to constrain inflation promptly. As inflation grew in intensity and the Fed's response grew correlatively, the losses in SVB's hold-to-maturity account grew larger. At the same time, the growing pressures in the economy were being felt in the tech sector that began to draw down their deposits. Ultimately, this required SVB to sell some of its treasury securities, recognizing a $1.8 billion loss on them. This drew the attention of the tech community that were its core depositors to the much larger losses in SVB's hold-to-maturity securities, leading Peter Thiel's Founders Fund to announce that it was withdrawing its money from Silicon Valley Bank, which was the proximate trigger for the run on the bank on March 9th, leading to its closure on March 10th. So I said there were lessons to be learned from this episode. Where might we look for those lessons? I think there are four main areas. First, there might be something in the structure of regulation, especially the comprehensive architecture of capital and liquidity regulation imposed by the Dodd-Frank legislation in 2010, that was flawed, and that if corrected might have prevented or ameliorated this episode. Second, there might be something in the changes in regulations in 2019 that made this episode more likely. Third, quite apart from the structure of regulation, there might be something in the structure of bank supervision, that is to say, the instructions that are given to the bank examiners that look at the condition of each bank regularly, that could be changed. And finally, there might be something in the oversight of bank examination that contributed. Perhaps the rules and the program were fine, but the examiners messed up, and who was supposed to be watching them? So first, let's dispose of the politically convenient but ultimately unsustainable argument that the deregulatory program of the last administration dangerously relaxed bank regulations in ways that contributed to, and perhaps approximately caused, the collapse of SVB. Since the bank's failure on the 10th of March, Senator Warren, for example, has been daily repeating variations of the same fundamental case. We told them not to touch it, they touched it, it broke, QED. As an argument, this is easily understandable, politically appealing, ideologically coherent, inherently persuasive, and just plain wrong. Let's look at the particular regulations that would have been at issue. So, first, capital. In 2019, the Federal Reserve changed the capital regulations that applied to banks of the size of Silicon Valley Bank so that they could opt out of holding capital against some of their treasury securities, securities that were held as available for sale. It was the sale of those available for sale securities in 2010, on March 9th, that triggered the run. And the argument is, if they had to raise that capital earlier, this wouldn't have happened. What that ignores is that the real concern of the depositors of Silicon Valley Bank, the articulated concern of Peter Thiel, were the losses in the held-to-maturity portfolio. That is to say, if a bank buys a treasury security, it can either say, I'm going to hold this so that I can sell it if I need to, or it can say, I'm going to hold this to maturity. And as I think many of the people in this room would be acutely aware, after some abuses in the late 90s and early 2000s, the accountants have become ferocious in ensuring that if a security is placed in the hold to maturity account, it will be held to maturity. You will not sell it. And as a consequence, the accounting rules and the regulatory rules, none of which was changed in 2019, do not require any recognition of changes in the value of securities that are being held to maturity if they don't have any credit risk in them. That was nothing that was changed. But that's where the real concern was. The concern that led to the devastating run at Silicon Valley Bank was they have built up a great deal of losses in these held to maturity securities, and accountants know if everybody comes for their money from the bank, they will have to sell them, and they will have to recognize those losses. The sale of the available for sale securities that generated a loss was simply the canary in the coal mine for the larger issue. So the capital rules would not really have affected this larger issue because they never would have required Silicon Valley Bank to hold capital against its hold to maturity securities. But more significantly, capital is never the issue in a bank run. Because of our fractional reserve banking system, no bank can withstand a run, no matter how much capital it has, unless it has simply taken all the money and put it into a lockbox and has not lent it out. The issue is liquidity and the bank's liquidity position. So there, the liquidity rules that would have the strongest liquidity rules that applied in the system. If we took the liquidity regulation that we applied to JP Morgan and applied that to Silicon Valley Bank before its failure, it would have said, you know, Silicon Valley Bank is in a decent liquidity position. It doesn't need to change anything. And the reason for that is because of the structure of its liabilities. It wasn't because of looking at the value of its assets. The liquidity regulation looks at it and says, you've got hold to maturity assets. We assume that those aren't available for sale to meet depositors' run needs. You've got these available for sale securities. Those are available for sale. So the question is, how much of your liabilities are likely to run against the securities that you have available to sell to satisfy that? And the structure of regulation has always looked at uninsured deposits as pretty stable. Not as stable as insured deposits, but pretty stable. What the liquidity regulation was designed to do was to discourage banks from taking on short-term wholesale funding from non-depositors, from taking on brokered deposits from non-customers, from taking on deposits from other financial institutions, all of which are treated as very hot money that will run at the first sign of trouble, and against which you must hold very short-term, immediately saleable securities. But your deposits, you take a little bit of a liquidity haircut against uninsured deposits, but not a ton. And as a consequence, the toughest liquidity regulation available, if applied to Silicon Valley Bank in the weeks before its failure, would not have raised any red flags at all. So if it's not something that was, now that may be an issue, but it's certainly nothing that's an issue with regulations that were changed in 2019. So what about supervision? The banking system is unique, I believe, certainly almost unique, and I think unique in our economy in the government interaction with it being not just a regulatory interaction, but regular and consistent supervision. There are examiners that go into every bank and determine not just whether it's complying with the regulations, but whether that examiner believes that the bank is being run in a safe and sound manner. And that can be very broad. A bank can be in complete compliance with the regulations and still have safety and soundness issues that an examiner brings to its attention and insists on having fixed. So maybe the regulations would have said that Silicon Valley Bank was fine, but surely an examiner going in and looking at a bank that has extremely chunky, very large, uninsured deposits and an increasing issue with a hole in its balance sheet from the interest rate risk on its treasury securities would say, you got to do something about this. Why didn't that happen, or why didn't it happen sooner for Silicon Valley Bank? Again, the answer, I believe, comes with the expectations that have developed both in the banking industry and in banking examiners and in banking regulators about the behavior of uninsured deposits. The examiners, as it happened, did go into Silicon Valley Bank and say, well, you have an interest rate risk here. We need to start working on this. Now, it's a little difficult to know what you do once you've constructed a portfolio like that and interest rate risks have started rising. It's like, well, the hold-to-maturity securities we can't sell. The accountants will have a fit. The available for sale securities we could start to sell, but maybe that would trigger the run sooner. It was, in fact, selling those securities that triggered the run. If we sell them sooner, maybe we trigger the run sooner. We could hedge. That's expensive. The accountants don't usually let you hedge against hold-to-maturity securities. So it's a complicated issue, and people were noodling about it, thinking about it as it began to grow, thinking to themselves, but thank heavens this bank is funded by its depositors. If this were a bank that had a lot of short-term wholesale funding, if we thought that its liability structure was extremely fragile, we'd have a big problem on our hands. But business depositors don't usually run. You know, a little bit, some, but not in the degree to which they did at Silicon Valley Bank. Historically, not just historically unprecedented, historically unimagined. So the question is, why was that? So as one looks for lessons from Silicon Valley Bank, I think the answer, the questions have to be, why did uninsured deposits behave differently? It's not what was wrong with the structure of regulation before. Yeah, there may be some things that can be changed in regulation as a result of that, but there was no glaring problem with the structure of regulation before. There was no issue with the changes that were made to regulation in 2019. There was no fecklessness or ineptness on the part of the supervisors who were looking at Silicon Valley Bank as this problem developed, because everybody was operating on what 50 years of experience would have told them. There's a problem here, but it's unlikely to be a flaming dumpster fire, as I said earlier this morning, because of the nature of its liabilities. Now, there are two main reasons, I think, as prime candidates for why those deposits behave differently. Did they behave differently because of the particular community that Silicon Valley Bank had focused its business on? Was it the fact that they were very concentrated? Maybe the fact that they were very concentrated in a particular group of people who are widely known to be subject to fads and enthusiasms and herd behavior. That may be. That calls for an answer of saying we should focus on diversifying the deposits of banks generally. It has long been a principle of banking that concentrated asset exposures are a problem. If you're concentrated in a particular industry, if you're concentrated in a particular geography, that's something that the bank examiners have always been after banks for, and trying to diversify asset exposures. Diversifying deposit exposures, less so. But maybe it should become more of a principle in banking if that is in fact the differentiating factor as to why Silicon Valley Bank's uninsured depositors behave differently. But maybe the uninsured depositors behave differently because it's 2023. And when Peter Thiel says, my founder's fund has withdrawn all of its money from Silicon Valley Bank, he feels an urgent need to post that on Twitter. And we feel an urgent need to respond to the little ping on our iPhone and say, everyone knows that Peter Thiel has just withdrawn all of his founder's fund's money from Silicon Valley Bank. And everyone can talk about that, and everyone can forward the tweet. And if you're concerned about it that night, you can rise from your bed, go to your computer, and move your account without talking to anyone. And if the reason that uninsured deposits behaved differently this time was not because they were all concentrated in one group of people who all sort of knew each other and would behave the same way, but because in the 21st century, that's how uninsured deposits are going to behave anywhere, then that calls for a different response, probably a different regulatory response in the regulation of liquidity, certainly a different supervisory practice in the supervision of liquidity. And the issues for that for the banking system could be significant because the inevitable consequence of those sorts of regulatory and supervisory changes will be to push for the consolidation of the U.S. banking industry even further than it has been before. As I said this morning, for those of you who were there this morning, when I began my career, there were 14,000 banks in the United States. Today, there are 4,000 banks in the United States. That's a significant degree of consolidation, but it is still a much more variegated and diverse banking system than in any other country in the world. The Canadians have 6 banks. I mean, maybe there are some tiny others that I'm aware of, but the Canadian banking system is 6 banks, 6 behemoth banks that do all of their banking services. The European banking system is similarly a small number of extremely large, concentrated banks. Our economy benefits from the dynamism of that more diverse banking sector. And if the necessary supervisory and regulatory response to a change in the behavior of uninsured deposits is to regulate those so that that's harder to do, then the cost of banking for those institutions will go up. The cost of banking may go up because we choose to insure all deposits in order so that uninsured deposits don't behave differently. But that will come with cost. One of the reasons why, there are a variety of reasons why we don't have deposit insurance for every deposit in the country. There are a variety of economic reasons why that would be viewed as creating moral hazard and other types of pathology in the behavior of the financial system generally. But another reason is that the industry doesn't want to pay for that much insurance because it's expensive. And so increasing the cost of regulation and the burden of supervision would inevitably drive more consolidation in this diverse banking industry that you have, driving us closer towards the Canadian or the European model as opposed to the US model that has served us so well. So I think those are some of the issues that we have to think about and address in considering the response to Silicon Valley Bank. What we should avoid doing is sort of a knee-jerk, more regulation of every sort has to be better. In Washington right now, they're saying we really have to put more capital in banks as a result of we've seen what happened in Silicon Valley Bank, more capital in big banks, more capital in regional banks, more capital in smaller banks. As we discussed, capital was not the issue here. There may be a reason to have more capital in some layers of banks or others. I mean, make your case. But Silicon Valley Bank is not an exhibit in the case. It didn't have anything to do with capital. But I think we will get more capital regulation and a higher capital burden on banks as a result of the Silicon Valley Bank episode. And that's why I think that the right answer is to focus on what really happened, what really mattered. I think it's this uninsured deposits question and getting to the bottom of why we think they behave differently. So those are current events. I began by saying that these questions of inflation and interest rates and financial stability, although all over the news, they are the least important questions about the Federal Reserve today. In my view, the big question is not what bank is going to fail tomorrow, not what the level of inflation is going to be in 6 months. The big question is how dominant will the role of the Federal Reserve be, not just in our financial system, but in our entire economy in a decade? And the answer to that is not clear. And it should be somewhat worrying to us that the answer to a question like that is not currently clear. I think it will be determined by 2 things, only one of which I'm going to talk about today. It will be determined by the continuing evolution of digital technology, and it will be determined by the degree to which politicians choose either to exploit or to constrain some hitherto dimly understood powers of the Federal Reserve that they are only now beginning to grasp. And that is why I took the title of my talk from Philip K. Dick's Do Androids Dream of Electric Sheep, which discussed the future in which technological advance, after a devastating pandemic, had created a dystopian world. To understand what's at stake, you first have to understand that the Federal Reserve is not a static, but it has been a constantly evolving organization. The Fed we have today is quite different from the entity that was created by the Federal Reserve Act of 1913. In fact, the Fed has had three main constitutional moments in its history, moments when its operation and power underwent dramatic change. The first, of course, was its founding in the early 20th century. The original Federal Reserve was quite a limited institution. It was fragmented in its power, it was decentralized in its governance, it was targeted in its objectives. It was created to address two main problems. It was meant to create an elastic currency that would expand and contract with the volume of economic activity in the country at any time. And it created a system to support stable bank credit by quickly moving banking reserves from banks with a surplus to banks in need. It created a so-called Federal Reserve, which is where the institution gets the name that it still goes by today. But given the historical suspicion of all concentrations of economic power in this country, the system created to meet these objectives was hobbled in a variety of ways. There would not be one central bank for the country, but there would be at least 12 scattered across the continent. And while there was an overall system board in Washington that set general policy, it had very limited authority and prestige. The clear weight of the system, by design, was in the reserve banks. So much so that in the early years of the Fed, one of the first heads of the board, the equivalent of our chairman of the Federal Reserve, resigned to take the position of the president of the Reserve Bank of Atlanta when it became vacant. Now, this system was better than what went before, and it lasted for roughly 20 years, but it didn't prove up to the task when it faced the existential challenge of the Great Depression. The Roosevelt administration, looking both for ideas and credibility in dealing with the country's ongoing banking crisis, reached out to, of all things, a Republican banker from Utah named Mariner Stoddard Eccles. Mariner Eccles is one of the unsung public servants of history, maybe sung a little bit louder here than in some parts of the country. But for the story today, he's important as the engineer of the Fed's second constitutional moment. Roosevelt asked him to head the Federal Reserve System, and he agreed on condition that the system be greatly modified. The board in Washington would be expanded, its powers increased, and although we'd still have 12 reserve banks, the center of gravity of the system would move from the reserve banks to the board and to its chairman. And now this is formally the system we still have today, but the Fed had yet another constitutional moment of equal importance, though it didn't change its formal legal structure. That third moment came in the early 1950s, and again featured Mariner Eccles. For almost a decade, interest rates had been pegged as a wartime necessity, keeping the cost of government financing low to help the war effort. After the war, Eccles wanted to break the peg, believing that continuing this practice in a peacetime economy would ignite inflation. President Truman did not. And things came to a head when, in an unprecedented and never repeated move, President Truman summoned the entire Federal Open Market Committee, the Federal Reserve's Monetary Policy Committee, to a meeting in the Oval Office where he would tell them how the cow ate the cabbage. After the Oval Office meeting, Truman then issued a statement saying the committee had agreed to keep interest rates fixed at the wartime peg. Eccles, in turn, released the minutes of the meeting to the New York Times, demonstrating that the Fed had done no such thing. Mariner Eccles and the Federal Reserve had called the president a liar in the country's paper of record. Headlines as big as your thumb dominated the national press for weeks, and eventually the Treasury and the Fed reached an agreement on March 4th, now known as the Treasury-Fed Accord of 1951. That is the source of the Fed's current independence from political direction regarding monetary policy. Now, the purpose of this brief history of the Fed is to show that the Federal Reserve has been a significantly, constantly evolving institution. And my message today is that we are in the middle of a fourth constitutional moment for the Federal Reserve, a moment in which the powers and operation of the institution could again expand dramatically, and which has been the subject of too little public discussion or reflection. As I said, that moment's being driven by two central developments, the first dealing with the nature of money, and the second with support for credit, just as at the founding of the Fed. Let me focus on the second of those, which is the Fed's potential, but hitherto very limited role in the provision of credit. A potential that was revealed during the Fed's response to the financial pressures of the COVID event in the spring of 2020. The COVID event caused an unprecedented, indeed previously unimagined, administrative shutdown of economic activity in the United States and much of the world. The Federal Reserve responded by creating lending facilities to provide direct credit support to households, to businesses, to state and local governments, under once obscure powers that had been granted to the Fed in the Great Depression, but almost never used. I supported those actions, and I still do, as the right response when faced with the specific challenges we faced in the spring of 2020. But I did at the time, and still do, have deep concerns about the possible precedents that have been created by those novel facilities that we designed. The Fed has always provided liquidity to the financial system in times of stress. That was the reason for its original creation. But providing credit directly to households and businesses and governments had been a red line that the Fed had virtually never passed before. The danger is that this support provided by the Fed does not require budget appropriation from the Congress, even though it is a real financial cost to the Treasury, because the Fed reduces its remittances to the Treasury by the cost of providing such support. Now, the absence of congressional appropriation is not a defect in response to a true emergency. The ability to act quickly is one of the prime reasons Congress gave the Fed this power. But extended provision of credit to broad sections of the economy without either a required appropriation or an effective limit could easily prove an impossible lure for future Congresses to resist under the guise of one emergency or another. Having established the precedent that the Fed can lend to businesses and municipalities for COVID, there will inevitably be those whose plans are grand and whose patience with democratic process is low, who will begin to ask why the Fed can't fund the repairs of the country's aging infrastructure, or finance the building of a border wall, or purchase trillions of dollars of green energy bonds, or underwrite the colonization of Mars. An entity that can do that without any need for congressional appropriations would be the financial equivalent of an attractive nuisance, which, as the lawyers among you know, is an instrumentality that a property owner allows to remain on his property, knowing that it will have an irresistible attraction to persons of impulsive and immature judgment, such as children and congressmen. It would encourage dangerous fiscal irresponsibility, and the annals of history are littered, from Sargon of Akkad forward, with the husks of empires that mistook vast wealth for limitless wealth, and vast power for the power to do anything they could conceive. Inflation and interest rates and banking stress will continue to dominate the headlines for months to come, but I hope I've made the case that the bigger questions about the Fed are yet to be addressed, and that all of you can now join in the debate in the coming years about how to address them. Thank you.
Randy, will you take a few minutes to have some questions? And I think I've got some assistants who will help me pass out these microphones so that others can hear. We're recording this via video in the back. Let me start by asking a very simple question, and it was raised in connection with the depositors at Silicon Valley Bank. In the Great Recession, we saw insurance deposit depositors' insurance rise from $100,000 to $250,000 per depositor. How do you think this event is going to affect that, if at all?
So my expectation, it wouldn't necessarily be my prescription, but my expectation is that there will be another increase in the size of deposits that can be covered by deposit insurance. The question is the size of that increase. There have been calls for deposit insurance to cover deposits as large as $10 million. I myself think that deposit insurance at that level would strike the wrong balance between sort of discipline and moral hazard and safety and stability. And I think politically, you probably get deposit insurance, probably going up to deposits of $1 million as a result of this. I don't think that, fundamentally, if deposit insurance had been $1 million at Silicon Valley Bank, that wouldn't have made any difference to the run at Silicon Valley Bank. I don't think that the politically achievable sort of level of maximum size of insurable deposit will ultimately address this, but I think that it's kind of an intuitively understandable and politically achievable result in something like the $1 million range.
Let's open it up. Right over.
Randy, I rarely would have this opportunity as one Yale lawyer to another to have you in a position to answer a question. This is my question. We have, with respect to deposit insurance, tacitly agreed that banks are too large to fail. And we put that category on the 4 largest banks at least. Then we have said another tier of banks are systematically important, so they won't be failed either. When we take the $17 trillion of deposits that are in the United States, we find that roughly 10 of those are in the uninsured category. When you take out the top 32 banks, you take out roughly 75% of the uninsured deposits. That is, uninsured deposits at J.P. Morgan are insured, but we don't call them insured. Same thing with Bank of America, and all the way down to Silicon Valley Bank and Signature. So now what we've got is $17 trillion in deposits and roughly 14.5 or 15 million that are insured, because we're taking the ones that are uninsured in those larger banks. So we really only are left with maybe 2.5 trillion that are in the category of being uninsured. Very small, and those would be banks smaller than Signature and Silicon Valley. When we bought banks during the time banks failed, we were not allowed to purchase a bank and not agree to assume all the deposits. Mm-hmm. So essentially, any of the small banks that failed, and that's what I was acquainted with, when we would go in and say, will you buy this bank, we weren't given the option to say, we'll only buy the deposits that are insured. They wanted all deposits insured. So how long has it been since any uninsured deposits in this country were not covered? My recollection is there were a few at the beginning of the Great Recession, but then we stopped. So if effectively the deposit insurance fund is covering 85% of the deposits, and in a practical way, whenever little banks fail, we're also covering all of those deposits, we have enough money. Why don't we just simply expand the insurance fund if we need to at all and cover all deposit? That solves all of those problems. The response is moral hazard. How can you expect depositors to figure out moral hazard if the operators of Silicon Valley Bank couldn't, and neither could San Francisco Fed?
So,
long question.
but a very core question to the discussion that will be being had here. So first, you have to acknowledge that the goal of regulation and the officially and the official position of the government is that there are no too big to fail banks currently. The reason for the structure of regulation after Dodd-Frank, and in particularly the emphasis, which some of you will be familiar with, on large banks doing their so-called living wills or resolution planning. So the largest and most complex banks in the country were required at just incredible expense in the first years after the great financial crisis to sort of streamline and clarify their legal structures so that it would be very clear if they came under pressure, yes, we can sell this subsidiary. Because it turned out that in the great financial crisis, you were trying to resolve institutions and all the ganglia were tangled up and you didn't quite know whether the knee bone was connected to the thigh bone. And it was not possible in any sort of certainly in any timely way, and possibly not possible at all, to separate them out. So structures were created to say that any bank of any size can be seized by the FDIC, sold immediately. The capital of the largest banks would be enough to ensure that all of their obligations could be met. So it is certainly the perception that the largest banks in the country are too big to fail, but it is not the official position of the government or the reason for the regulatory structure. If that were going to be the reason, then you'd say, well, we don't need a lot of this resolution planning, for example. Now, if it was also, before the great financial crisis, the official position of the Treasury that the housing finance corporations, Fannie Mae and Freddie Mac, did not benefit from a government backstop beyond a very limited formal legal line of credit from the Treasury, and say, look, you need to understand if these entities fail, they will fail. We'll do nothing about it. And as an official in the Treasury, I said that over and over and over. And the market said, we don't believe you. And it turns out they were right and I was wrong. So, we could face that situation today where the official position of the government is, if JP Morgan fails tomorrow, it has failed, right? And we will, the FDIC will take it over and we'll sell off the pieces and the depositors will be covered, that will all be fine. You may be right that that won't happen. But it's not, it's difficult for the policymakers to begin to adopt policies acknowledging that it won't happen because the official position is that, yes, it will. I think as well, your example, the question raises something that I hadn't talked about here that I think is quite important, which is how did the FDIC resolve Silicon Valley Bank? I mean, the whole system works. The whole system is designed so that a $100 billion bank can fail and the system will sail on without a lot of extraordinary efforts and without a lot of headlines in the papers and maybe a headline, that's kind of big to fail, but that can happen. But that will depend on the FDIC doing for a bank that size what it does for smaller banks, to acknowledge that, well, the bank has failed, we'll have an acquirer come in, and if on the morning that they announced that Silicon Valley Bank had been seized, they had said, X bank has taken it over and all of the uninsured deposits will be covered by the acquirer. The acquirer wants the deposits, and as you say, I mean, that's the drill, that's part of the system, that's part of how the entire framework maintains confidence in the system. If we're going to say banks can fail, then the FDIC has to be able to fail banks in a way that maintains confidence in the system. They didn't do that this time. There is reason to believe that they didn't do that because they excluded a number of potential acquirers from the process at the outset. And also asked for some additional types of commitments from acquirers that are not typical in an emergency acquisition. And once you both significantly decrease the universe of potential acquirers and start adding additional leg weights onto those who are allowed to enter the race, you greatly increase the likelihood that nobody comes across the finish line, and that didn't happen. By Sunday, they were clearly saying to everyone, okay, yeah, just take this off our hands. And by that time, people were saying, well, so much value has been destroyed here, we're not sure that we want to do it. And so for 2 weeks, it was unclear what the fate of Silicon Valley Bank was going to be. That contributed significantly to the pressure across the system. So I do think that if we're going to maintain the structure that we have, and there are reasons for maintaining the structure that we have, where any bank can fail, you have to be able to do that in an effective way that maintains confidence in the system, and that does require the FDIC to seek a private sector solution that will cover all the deposits without sort of having to do what they did on Sunday afternoon, which is to announce, okay, we're covering all the deposits in Silicon Valley Bank anyway, and leaving a lot of unclarity about whether deposits were covered elsewhere in the system, because they said we're covering it in those two institutions. And then Secretary Yellen came out and said, well, we're not sure that we're going to cover other uninsured deposits. And that created more ructions. And so she said, well, yeah, we probably are, but we're not. And, all of those complications would be avoided if the FDIC had just said, it's Friday morning, we took over the bank, and it's now owned by X. Think of how when the airlines go bankrupt. Right? The first time, those of us who are old enough to remember the first time the airlines went bankrupt, it was, oh my gosh, this is critical to the economy. How will you get anywhere? The airlines are bankrupt. And after a short period of time, it became clear, oh, well, it's just fine, right? The airlines continue to operate. They weren't hit by a nuclear bomb. They just went bankrupt. And so they're going to continue to operate. And then the second time the airlines went bankrupt, it was in the middle of the B section of the paper, and you were hardly aware of it. If the obligation of the system is to try to ensure that the failure of even a largish and important institution will be felt in exactly that way.
Randy, I regret we've come to the end of our time. I know there are many here who would love to impose on you and have you all afternoon, but we can't do that. Let's just thank him for wonderful work.
Thanks. Thank you.
Thank you. I just want to say that I'm sure that George Eccles would be delighted with the contribution that has been made today in fostering economic literacy. It's just been a great feast for us all. Thank you so much for these wonderful, wonderful perspectives. And given the arc of your career and your little bit of gray hair left, I think I can say this as someone who's a little older than you, that we wish you and Sinosure much, much success in the private sector, because we know that it will feed the George and Dolores Dory Eccles Foundation, which will continue to do great things for the state of Utah, and we're delighted about that. But we also hope that the arc of your career lasts long enough that you can go back as either Fed Chairman or Secretary of Treasury. And we appreciate very much what you've done today. Thank you. And thank you all for coming.